Oh my gosh, home sales just absolutely got reamed. We were expecting a month-over-month decline of 4% for pending home sales. We actually got a negative 10% decline in September, way worse than expected. Sales are now down 31% year over year. And this is where a lot of folks who talk about the housing market say, hey, but inventory is still in short supply. Yes, maybe. Inventory might be at much lower levels than what we've previously seen, but if you start actually selling less of these homes, the metric of months supply of homes extends. That's because if, let's say in a normal market, you have 200 homes on the market, but now you have 100 homes on the market, you have half the supply. But if usually 10 sell a month, that would be 10 months of supply. But if now only 5 are selling a month, you have 20 months of supply. So the fact that less homes are selling is a concern for how much home prices could continue to fall. And in this video, I want to touch on some of the reasons we could actually see that sort of supply increase and we could continue to see pain in the mortgage rate market. Now, first things first, generally, we pay attention to the 10-year Treasury yield for what inflation is doing. And I think we're going to still have a very hawkish Federal Reserve here in the November 2nd meeting, which is likely to drive and keep those 10-year Treasury yields right around 4%, which is roughly where we sit now. I don't really expect these Treasury yields to peak until 2 to 3 months before we actually see the Federal Reserve get to peak rate hiking cycle, or a rate hiking cycle, which if we expect the Fed to peak out on rate hiking around March of 2023, we're probably going to see the 10-year peak closer to January of 2023. Now, with a 10-year sitting at 3.99, we're really seeing mortgage rates above 7%. You could easily see this just by typing into Google mortgage rates. I generally recommend you change this interest rate to 740. That's generally your prime mortgage rate. And you can see that mortgage rates for the 30-year fixed are sitting at about 7.2%. That's a solid 4.5% greater than where we sat in December of last year, which reduces about 45% of buyer purchasing power. But there's a problem with mortgages, and that's the potential that the Federal Reserve starts selling off mortgage-backed securities. See, unlike treasuries where they just roll them off, mortgage-backed securities might actually begin to be sold by the Federal Reserve. And this is going to create a very, very real risk for real estate. The 10-year Treasury yield could begin to fall early next year. But mortgage rates could potentially stay high if the Federal Reserve starts selling mortgage bonds, which means that we will see prices for bonds on mortgages come down and mortgage bonds actually increase. That means you see what's known as a wider spread between risk-free treasuries and mortgage rates. And when credit spreads rise, you could actually be in a situation where the 10-year trends down while mortgage rates continue to trend up. And the Fed, while they've been talking about selling mortgages, mortgage-backed securities, they have not actually undertaken, excuse me, they have not actually undertaken, I'm still getting over this cold, it was ridiculous. They have actually not undertaken selling MBSs yet, mortgage-backed securities. When that occurs, there could be some real fears that mortgage rates continue to maintain higher levels and we see more pressure on the real estate market. Take a look here. This shows us that with caps on redemptions on treasuries and agency mortgage-backed securities doubling in September, the pace of the balance sheet runoff was set to increase in the coming months. The markets for treasury securities and agency mortgage-backed securities continue to function, although liquidity conditions in both markets remain low. Low liquidity conditions is not good. That means you have less buyers for treasuries and mortgage-backed securities. Less buyers means higher rates. And listen to this, we're starting to get this talk. A couple of participants remarked that after the process of balance sheet reduction was well underway, it would be appropriate for the committee to consider the sale of mortgage-backed securities in order to enable suitable progress to their longer-term goals. Notice, folks, this was the report of the minutes that came out just a few weeks ago from the Fed Reserve meeting of September 20th. So they're already having murmurings of dumping mortgage-backed securities. Dump mortgage-backed securities, and what do you end up with? You end up with more pain for the housing market, which obviously is great for my startup currently accepting accredited investors, House Hack. But in addition to that, when we see pain in the bond market, we potentially create a new cohort of sellers for real estate, and that's pension funds selling real estate. See, most people think about individuals selling real estate as being the driver of what is going to increase inventory for the real estate market. And really, in order for people to sell a home right now, they would, in my opinion, have to be willing to rent at high rents or move into another property that they own. I don't think a lot of homeowners really want to sell right now and buy a new home. In fact, when we look at the Pulte earnings report and Pulte Homes report, we find that move-up buyers are down like 31%. Compared to last year. So you're really seeing less of a transition there, and it makes sense because you'd be going from a mortgage rate of, say, 3% to 7.5%. Like, why would you be doing that? That doesn't make sense right now. But that's okay because you don't need that cohort to sell. All you really need to see pain in the real estate market is rental property owners selling or pension funds starting to sell. And unfortunately, you're likely to continue to see that sort of pain increase over the next months. Why? Because, well, take a look at things like what's happening in the United Kingdom, who's having its real bond crisis. We just saw the central bank of the United Kingdom have to essentially turn on the money printer again to bail out the bond market because of pain. And so as a result of this pain in the bond market, what's happening? Real estate funds whose investors include pension funds have began offering properties for sale to meet redemption requests. In other words, people are taking their money out of funds, real estate funds. Pension funds are taking their money out of real estate funds. And that is forcing real estate funds to have to start offloading properties. Pooled pension property funds are selling warehouses, residential properties are being sold. Any kind of property is likely to come up on the market. Why? Because here you go. Pension funds have been dumping stocks, bonds, collateralized loan obligations, as well as pulling money from almost any fund that'll give it back. The more pension funds pull back, the more real estate funds have to start dumping real estate. This is a Bloomberg article here from just, 9 days ago here. This is recent information. And it's recent information that unfortunately is likely to get worse. And it's not just commercial real estate, it's also residential real estate. And that's just the nature of pension funds having to balance the fact that they have a lot of debt. Unfortunately, a lot of this occurs with a lag in the real estate market. And that unfortunately leads to pain likely not really being fully realized in the real estate market until we start lapping the highs of real estate prices that occurred between March and May of 2022. Lapping means we get to a year-over-year lap where all of a sudden in March to May of 2023, we're comparing back to the high peaks at the beginning of 2022 when mortgage rates were still relatively low. And that's when we potentially see real fear enter the real estate market, which hopefully actually occurs after the pain of the stock market pain. Because presently, if you have pension fund recipients or really retirees who are also invested in a balanced stock and bond portfolio, they've been absolutely decimated. On average, bonds are down just as much as the stock market, 20 to 30%. And a retiree who's relying on their homeowner equity and their diversified stock and bond portfolio, they've been destroyed this year. And their retirement is in question. The last thing people want to do is potentially, as a retiree, sit through another real estate cycle where real estate prices are bottoming out and their opportunity to stay retired is in jeopardy and the risk of them having to go back to work rises. It would make more sense for a retiree to say, you know what, let's downsize now, even if it means renting, but let's capture our homeowner equity since our taxes are potentially low anyway because their income might be lower, pay the cap gains that you need to, but take money off the Vegas table so that way you could retire with the equity you have now rather than having to maybe wait another 5 years for that equity to build back up or more. So a lot of risks coming to the real estate space, but I really believe these risks will create an opportunity. The most important thing for you to remember though is that during real estate recessions, the average home ownership rate declines. That means less homeowners are buying homes. That means more investors are able to buy homes. That's because investors tend to have cash, like HouseHack has millions of dollars of cash available and probably will have in excess of $50, $60 million available in not only purchasing power, but cash. come 2023. That those are companies that can go buy. Individuals, unfortunately, tend to see their incomes decline or layoffs happen, or they didn't properly prepare by getting out of debt to be able to afford real estate. And so what ends up happening? Well, they end up in a situation where they can't qualify for real estate, and investors are the only ones who can at the bottom of the market. And then again, individual investors get screwed, not because there are other investors, but because they themselves can't qualify. And that's a downside. So I would do whatever I could if I were in your situation to increase your income, minimize your debt, maximize your own opportunity to qualify for real estate, to make sure that you can buy when the time is right, which will probably, in my opinion, be sometime in 2023. And we might even have some patience into 2024 because the real estate market does move so much slower. Anyway, thanks so much for watching this. We'll see you in the next one. Goodbye.